Most people spend 40 years building their retirement nest egg, and then they spend the first 3 years of retirement accidentally destroying it. And it's not because they didn't save enough money, it's not because the market crashed, but it's because nobody ever taught them or showed them exactly how to turn what they built into income that lasts the rest of their lives. And today, that's exactly what we're going to fix. And as a wealth manager, I've spent the last 7 years sitting across the table from some very successful people. I'm talking doctors, business owners, executives, people who did everything right their entire careers. And almost every single one of them comes to me with the exact same problem. They had the money, but they had no plan on how to make that money work once the paycheck stops. So if you're within 10 years of retirement, or you're already there and you're not 100% sure your income is going to last as long as you do, this video was made for you. So stick with me for the next 10 minutes because what I'm about to share with you could literally be worth hundreds of thousands of dollars over the course of retirement. I'm not just saying that to be dramatic. I'm saying it because the math is real and I'm going to show it to you. But before I get into the strategy, I want to tell you why this topic is so personal to me. Early in my career, I had a client, I'll just call him Robert. Robert was 68 years old at the time, retired engineer. He spent 35 plus years working for the same company. He was a disciplined saver. And when he walked into my office, he had about $1.1 million saved up. On paper, he was doing great, but Robert had a problem no one ever had addressed with him, and he had spent his entire career in accumulation mode, saving, growing, building. And the moment he retired, everything changed. Now he had to distribute the money in a way that would last the next 30 plus years to cover healthcare costs, manage taxes, and keep up with inflation. Nobody ever sat down with Robert and built him a distribution plan. So what did Robert do? Exactly what most people do. And he just started pulling money from his accounts whenever he needed it. No strategy, no tax structure, no planning, just I need the money, let me take it out. Within 4 years, Robert had unknowingly pushed himself into a higher tax bracket, triggered higher Medicare premiums, and made a Social Security 85% taxable. He didn't make a bad investment choice. He just had no income plan. And here's the thing that broke my heart. And Robert thought he was being responsible. He thought because he had saved the money, the hard part was over. That conversation with Robert changed the way I do everything, because that's when I realized that the financial industry spends 99% of its time teaching people how to build wealth and almost zero time teaching people how to live off of it. Saving the money is only half the game. The half nobody prepares you for is keeping it. So I made it my mission to understand retirement income planning at the deepest level. And today I want to give you everything that I've learned so you don't end up like Robert. All right, so let's get into the meat of this, because before I give you the strategy, I need to address the 3 beliefs that are costing retirees money every single day. These are the big 3 false beliefs that I hear constantly, and every single one of them needs to go. False beliefs number 1 is the vehicle that you're using. And something I hear all the time is, I just need a good rate of return and I'll be just fine. I hear this all the time and I get it. It makes sense on the surface level. More growth equals more money, right? But here's the problem. In retirement income planning is not just an investment problem, it's a distribution problem. Think about it this way. Imagine 2 retirees, both have $1 million saved up, both have an average of 7% in returns over 20 years. Retiree A retires in a year when the market is up and his portfolio grows before he really needs to start taking money out. Retiree B, on the other hand, retires when the market tanks 25% right out of the gate. The same average return over the course of 20 years, but because retiree B takes out money in down years, he runs out of money 8 years before retiree A. Same return, completely different outcome. And this is called sequence of returns risk, and it's one of the most dangerous and least talked about threats to your retirement. It's not about what your money earns, it's about when it earns it. So retiring into a down market without a protection strategy is one of the most expensive mistakes that you will ever make. And you won't even realize it happened until it's way too late. So the solution here, the solution to this problem is you'll need what I call a bucketing strategy. So you segment your money into 3 different buckets. And bucket number 1 is your safety bucket. So 2 to 3 years of living expenses in cash or stable accounts. This is your sleep at night money. When the market drops, you draw from these accounts, not from your investment accounts. You never sell at a loss because you never have to. Bucket number 2 is your income or fixed income bucket. We're talking annuities, real estate, dividend producing assets. This refills bucket number 1 over time and provides a steady, predictable income stream. And then you have bucket number 3, which is your growth bucket. This is your long-term money. We're talking equities, index funds, growth assets, because you're not touching this bucket until 7 to 10 years from now. It can ride out the market cycle until it fully recovers. See, when your money is structured this way, a market crash becomes inconvenient and not catastrophic to your entire portfolio. Then you have false belief number 2 is the internal belief. And most people I meet with tell me the same thing. And I'm not the kind of person who has to worry about taxes in retirement. I'll be in a lower tax bracket. And this is one that costs so many people so much money. And here's the reality. And for most people, retirement is not a lower tax environment. It's just a different tax environment. And if you're not planning for it specifically, it can actually be a higher tax environment for you depending on your situation. And here's why. See, you spent the last 30 years contributing to a traditional 401k or an IRA, and every dollar in those accounts has never been taxed. And then the government has been very, very patient, but they will get their money eventually. At age 73, for an example, the IRS mandates that you start taking required minimum distributions from those accounts, whether you need the money or not. And as your account grows, those RMDs grow as well, which pushes you into a higher income tax bracket. It can push you into a higher Social Security tax, all the way up to 85%, which can trigger higher Medicare premiums through something I call, or the IRS calls, IRMAA. So one domino and suddenly everything costs more. The government has been your silent business partner in your entire career. See, retirement is when they finally send you the bill. The question is whether you let them decide how much, or whether you take control of that number right now. The solution is what we call tax diversification. So you want your money in 3 different tax brackets. So you've got your taxable accounts, your brokerage accounts, your bank accounts, which are flexible but are still taxed. Then you have your tax deferred accounts, your traditional IRAs, your 401ks. You pay taxes when you take the money out. Then you have my favorite, the tax-free accounts, the Roth IRA, the Roth 401k, certain life insurance structures. You pay taxes now, but never again. The goal is to have enough in each bucket so that when we strategically pull income from these buckets, you're being tax efficient every single year. This is what separates a retirement plan from a retirement account. Then we have false belief number 3, the external belief. And Social Security will cover my basic needs so I don't have to stretch too much about income planning for retirement. Now, I'm going to be really honest with you here, and I say this out of respect because I know a lot of people that are counting on Social Security to take care of their fixed expenses. But Social Security was never designed to be your primary income source in retirement. It was designed to supplement your income, and the average Social Security benefit right now is about $1,900 a month. That's just under $23,000 a year. And that is not enough for most people to live off of every year in retirement. For most people, it's absolutely not even close. And here's the kicker. When you claim Social Security, it matters big time. And there's a million different ways to take Social Security. At age 62, you lock in a permanently reduced benefit, sometimes 30% less than if you waited. And if you claim at full retirement age, you get the full benefit. But if you wait until you're 70, then your benefit grows 8% every single year that you delay. That's a guaranteed 8% return, which in today's environment is unbelievable. Claiming Social Security early because you're afraid the program is not going to be there is one of the most expensive decisions that you can make. See, here you could be leaving hundreds of thousands of dollars or more on the table over the course of your lifetime. That's guaranteed money that you simply chose not to take. Now, that doesn't mean that everyone should wait until 70 years of age, right? Because you have health, you've got cash flow, you have marital status, and other income sources that all play a role. But this decision needs to be made strategically as part of a comprehensive income plan and not out of emotion and definitely not out of fear. And that brings me to the most important point of this entire video. And you'll want to make sure that you're stacking, right? So here's what I want you to take away from everything that I just shared. And you'll want to remember that retirement income planning, it's not just one thing. It's not just picking a safe withdrawal rate. It's not just choosing the right investments. And it's definitely not just filing Social Security at the right time. It's a comprehensive, coordinated strategy that stacks multiple pieces together. And here's the thing, when those pieces work together, the result is dramatically better than any single piece working on its own. So let me show you what stacking actually looks like, right? So you'll have number one, your layer number one is your income floor. Identify your non-negotiable monthly expenses, mortgage, rent, groceries, utilities, healthcare. These need to be covered by guaranteed income sources like Social Security, a pension if you have one, and potentially an income annuity. So this is your foundation, and no matter what the market does, the bills always get paid. Then you have layer number two. This is your bucket strategy. So as we talked about, segment your investment assets into safety, income, and growth buckets. See, this protects you from sequence of returns risks, and it allows your growth assets to do what they're designed to do without the emotional pressure of needing them at that current moment. Then you have layer three. This is your tax strategy work with your advisor, and you built a multi-year Roth conversion strategy during the early years of retirement, especially the window between when you retire and then when you're forced to take out RMDs. These are your lowest income years and your best opportunity to move into a tax-free account at the lowest possible tax rate. Then you have layer four. This is your healthcare bridge. See, if you retire before 65, you need a plan for healthcare before Medicare kicks in at 65. This is significant and often underestimated expense that could derail an otherwise solid retirement plan if it's not addressed specifically. And last but not least, you have your legacy protection, and you want to make sure your estate documents are current. Your will, your power of attorney, your healthcare directive, and beneficiary designation on every single one of your accounts. And if you have significant assets, you want to consider whether life insurance, maybe even long-term care coverage needs to play a role in protecting your family from a healthcare event that could wipe out decades of saving. A retirement income plan is not a product. It's not an account. It's not just a strategy. And the difference between someone who runs out of money in retirement and someone who leaves a legacy is almost always the plan, not the balance. You see, when all 5 of these layers that I just talked about are working together, You don't just have money in retirement. You have confidence, which changes everything. And you have the ability to spend without guilt. You have the ability to give without hesitation. And you live without constantly worrying if the math is going to work out for you. And that's exactly what retirement is supposed to feel like. So listen, I know that was a lot of information. And if you're feeling even the slightest bit overwhelmed right now, that's actually a good sign. It means you're taking all this information seriously, and you should, because it's one of the most important financial decisions you'll ever make, right? But here's what I don't want you to do. I don't want you to watch this video and feel motivated for 20 minutes and then go back to not doing anything at all. Because here's the truth. The best retirement income plan is not the most complicated one, right? You hear the term less is more. The best retirement plan is the one that actually gets built. So here's your next simple move, just one step that you can do. And you'll want to take out a piece of paper right now and write down 3 questions, right? So the first question is, do I actually know exactly how much guaranteed income I will have or need every month in retirement? That's the first question. The second question is, do I have a specific tax strategy for the next 10 years? And last but not least, do I know what my money is actually doing and whether it's structured for income and not just growth? And if you are somebody who can't answer all 3 questions with confidence, that is your starting point. That is a conversation that is worth having. And you didn't spend 40 years building your retirement nest egg to leave it to chance. The most important financial chapter of your life, you owe that to yourself and the people that you love to have a plan that's as serious as the work that it took you to get to this point. And if you found this video useful, please hit the like button and subscribe to my channel. I like to put out content like this every single week, designed specifically for people who want to make smarter money decisions. And if you want to have a direct conversation with me, feel free to click the link in the descriptions, and you can schedule a free consultation with me. We'll just have a conversation about your current situation and whether or not I can help or somebody on my team can help you out. So I'll see you in the next one. Take care.